All right, who wouldn't love an extra $100 a month just kind of showing up, without having to actually work for it?
Yeah. Definitely a nice thought, right?
Exactly. That's kind of like the whole draw of dividend investing, isn't it? That idea of passive income.
Passive income, it's definitely appealing.
Yeah. So that's what we're going to be looking at today. We're diving into a YouTube short from Honest Finance, and the title is How to Make $100 per Month in Dividends.
Catchy title.
Very catchy. So we're going to break down their kind of calculation method, but we're also going to go a bit deeper and really explore what it actually takes to build that stream of dividend income.
This is good.
So the video starts off, and they immediately, like the first thing they do is they take that $100 a month goal and they convert it to an annual amount.
Right. So $100 a month times 12 months, that's $1,200 a year.
Right, $1,200 a year, and I guess that kind of makes it easier to wrap your head around.
Right, exactly. Because dividend yields are typically expressed on an annual basis. So you're kind of putting everything in the same playing field.
All right, so instead of thinking about it month to month, you're thinking about it over the whole year.
Right.
Which I guess makes sense when you're comparing different potential investments.
Exactly. You need that apples to apples comparison.
So then the video, they use Coca-Cola as an example, because everybody knows Coca-Cola.
Yeah, pretty recognizable brand.
Right, so everybody kind of has a feel for it. And they say that their current dividend yield is 2.59%.
2.59%.
So when I saw that, I was like, huh, is that a good number, or is that bad, or is that just kind of like average?
Yeah, it's a natural question to ask. I think most people, when they first start looking at dividend yields, are kind of like, okay, is this high? Is this low? What's the benchmark?
Right, because, I mean, like on the surface, a higher yield always seems better, right?
Right, on the surface, absolutely, because you want that bigger return.
But then that kind of makes me think, is there like a catch? Is there some kind of like trade-off?
Well, there can be, and this is where you got to start thinking a little bit deeper than just the raw number.
So what could be some reasons why like a super high dividend yield might actually not be such a great thing?
So sometimes a really high dividend yield can actually be a red flag potentially.
A red flag, okay.
Yeah, like if a company's stock price has dropped significantly, maybe they're having some trouble.
Oh, right, their share price could have tanked.
Exactly. The price tanks, but they're still paying out the same dividend, so suddenly the yield looks really high, but it might not be sustainable.
Oh, I see. So it's not necessarily that they're doing really well, it's that their price has gone down.
Right, exactly. It can be a bit misleading, so you got to look at the bigger picture.
So what else could be going on?
Another thing to consider is the company's payout ratio. Have you ever heard of that term before?
Payout ratio? Not really.
So the payout ratio basically tells you what percentage of the company's earnings are being paid out as dividends.
Oh, okay. So, like, are they giving away all their profits, or are they keeping some to reinvest in the business?
Exactly. If a company has a really high payout ratio, like say 80%, 90%, or even more, that can be a sign that they're stretching themselves thin to keep those dividends flowing.
Okay, so even if it looks good on paper, like even with Coca-Cola at 2.59%,
Yeah,
we still can't just assume that it's a smart investment.
exactly. You got to do your homework.
Right. Research, research, research.
Always more research.
Okay, so let's get back to the videos, like the way they do the math, right?
Yeah.
So they take that yield and they're trying to figure out how much money do you actually need to invest to get to your goal of $1,200 a year?
Right. So they do a simple division. They take that $1,200, which is the annual dividend income goal,
Okay.
and they divide it by the dividend yield, which in Coca-Cola's case was 0.0259.
And they came up with a big number, didn't they?
They did. It came out to $46,332.
Wow. $46,332. That's like, I mean, that's a lot of money.
It's a significant chunk of change. Yeah, for most people, that's not just spare change lying around.
Yeah, and also, I mean, most people wouldn't just put all their money into one company, would they?
No, absolutely not. That's a huge no-no in the investing world.
Why is it, like, what's the big deal about putting all your eggs in one basket?
Well, think about it if something goes wrong with that one company.
Oh, yeah. Your whole plan is screwed.
Your entire investment is at risk. Diversification is absolutely key. You want to spread your investments across multiple companies, different industries, different asset classes. Even that way, if one investment takes a hit.
Right, the others can kind of cushion the blow.
Exactly. You're not putting all your eggs in one basket, so you're mitigating that risk.
So it sounds like we've got the yield, we got to think about risk, we got to think about diversification. Is there anything else that somebody who's just kind of starting out with this whole dividend investing thing should be considering?
Taxes for sure.
Oh, yeah, taxes. What about them?
Dividend income is generally taxable, so you've got to factor that into your calculations.
Right, you don't get to keep all of it.
Unfortunately not. Uncle Sam wants his cut.
And how much you have to pay in taxes can really vary depending on like your tax bracket and stuff, right?
Absolutely. And then there's another thing to keep in mind. Even established companies like Coca-Cola,
Yeah.
they can cut their dividends if they hit hard times. It's not a guaranteed thing forever.
Oh, wow. So even Coca-Cola could be like, hey, sorry guys, no more dividends this year.
It's happened before. It's not common, but it can happen. Companies can face unexpected challenges, economic downturns, whatever it might be, and they might have to make tough decisions like cutting their dividend.
So it's not like a guaranteed thing that just because they're paying it now, they'll keep paying it forever.
Exactly right. There's always some level of risk involved.
So this is making me think that maybe just chasing that $100 a month, like just focusing on that one number, might be too narrow of an approach.
I think that's a great point to bring up. It's not just about hitting a specific dollar amount. It's about building a sustainable long-term strategy.
So what could be some other ways to reach that same goal of having like an extra $100 a month?
Well, there are definitely other paths you could consider. You could focus on growing your investment principal more aggressively, even if that means accepting lower dividends initially.
Oh, so like invest in companies that are maybe growing faster, even if they're not paying out as much in dividends right now.
Exactly. The idea is that as those companies grow and become more profitable, their dividends will likely increase over time, and you'll end up with a larger income stream down the line.
So it's kind of like playing the long game.
Exactly. It's a long-term strategy.
So it seems like this video gave us a really good starting point.
Yeah,
but there's
yeah.
definitely a lot more to consider than just that simple calculation.
Absolutely. Dividend investing, it's not just about plugging numbers into a formula.
Right. You got to do your research.
Yeah.
Got to understand your own personal risk tolerance and really not get too hung up on just hitting that one magic number.
Right. It's about the bigger picture.
So we've talked about dividend investing, but are there other ways to build passive income?
Oh, absolutely. Tons of ways.
Like what?
Well, you've got real estate. You can invest in rental properties, generate income that way.
Yeah.
You could start an online business, create a product or service that generates recurring revenue.
Right. So you don't even have to deal with like tenants and toilets and stuff.
Exactly. And there are even certain types of bonds that can provide a steady stream of income.
Oh, yeah. Bonds. I always forget about bonds.
They're not as flashy as stocks, but they can be a solid part of a diversified portfolio.
So it seems like there are a lot of different options out there for building passive income. It's not just limited to dividends.
Exactly. It's all about finding what works best for your individual circumstances, your risk tolerance, your financial goals.
Wow, this has been really eye-opening. We started with this simple little YouTube short, and now we've gone so much deeper into the whole world of passive income.
It's amazing how one little video can spark such a wide-ranging conversation.
Yeah, and I think that's what we're all about here on the Deep Dive.
Yeah.
Like, we want to take these bite-sized pieces of information and really unpack them, explore all the different angles.
Exactly. It's about going beyond the surface level.
Right, because there's always more to the story.
Always more to learn.
Well, hey, thank you so much for all the insights. This has been awesome.
It's been my pleasure.
And for everyone listening, remember this deep dive, it's just the beginning.
Right. Consider this your jumping off point.
Keep learning, stay curious, and make those dividends work for you.
Or find some other awesome way to generate passive income, whatever works best for you.
Exactly. There are so many possibilities out there.
Sky's the limit.
All right. Until next time, happy investing, everyone.
See ya.
Bye.
Bye.